This video will record Ingersoll-Rand Corporation through the lens of Fast Graphs, the fundamental analyzer software tool. We're going to start by looking at a 20-year historical earnings and price correlated fast graph on Ingersoll-Rand, which is as far back as we can go. As you can see, the orange line here plots earnings per share. This is since 1992. The light blue shaded area shows dividends paid out of earnings. The black line is the monthly closing stock price line. And the dark blue line shows the normal PE ratio, which correlates very closely to the company's earnings growth rate. What's important about this graph is the price and earnings relationship. You can see that stock price follows earnings very closely and correlates very closely to what earnings are doing. When earnings are rising, stock prices are rising. When earnings is falling, stock price is falling, and vice versa. We're now going to shorten this to a 15-year graph so that we can see more detail on the graph as we review this company. As you can see, earnings growth has been very cyclical, reacted very strongly to the recession of 2001. We saw a sharp drop in earnings of 38%. This was followed by a strong rise in earnings, and of course you can see stock price responded accordingly. Then we had some cyclicality in earnings again, and we saw this huge precipitous drop in stock prices, which obviously was horrific and really unnerved investors. But at the same time, we can also see that it created one of the best buying opportunities to purchase this company in this entire history, because as earnings recovered, stock price recovered dramatically also. You'll notice that price came from the low teens and got all the way up into the 50s, which really was above its earnings justified value, and has subsequently now fallen back into what could be an undervalued situation with the current PE at 13 times earnings. The company pays a 1.3% dividend yield, and we look at performance associated with this graph. We see a couple of things. Number one is they generated a 6.5% compounded rate of return, which is actually very close to the 7.1% earnings growth that the company achieved, because valuations were pretty much in line. A $100,000 investment would have grown to $251,000. That would have outproduced the S&P 500 over the same time frame, and it also paid out a very generous amount of dividends, more than the average company, $41,778 versus $38,000 in the S&P. However, we do want to point out that during the recession of 2001, dividends were froze at 34 cents, and then coming into the Great Recession of 2008 and 2009, we actually saw dividends cut from 72 cents, which was their high. They were initially froze, then cut to 50 cents, all the way down to 28 cents, and they're now expected to begin rising again. The current consensus estimate, however, for this company as it's coming out of the recession is to grow over the next 3 to 5 years at about 15% per annum. If that's true, then there's still a lot of upside opportunity now that Ingersoll-Rand stock price has come back down into reasonable valuations. This is one of the highest estimated earnings growth rates produced by Value Line. However, if we look at consensus earnings, we see that the consensus of leading analysts reporting to First Call actually expect this company's earnings to grow by 14%. So the 14 or 15% consensus seems to be at least realistic based on most analysts following the company. If that's true and the company trades at a normal price earnings ratio of 15, the stock could trade in the mid-90s by year-end 2016. This has been an earnings and price correlated review of Ingersoll-Rand Corporation through the lens of Fast Graphs, fundamental analyzer software tool.